My name is Tommy Shaw, and on today's topic, what I'll be talking about is creating wealth using real estate. So a little bit about me, okay? My name is Tommy Shaw. I just said that. I am a real estate owner, buy and hold strategy, an ETF investor, a stock investor. I studied in finance. And remember to subscribe, many more videos to come, posting at least once a week. Content will be on investing, saving, and increasing awareness to attract more abundance in your life. So understanding these principles will make you wealthy. If you don't understand them, it's practically impossible for you to become wealthy, because there's two ways you can make instant equity, and you can make it through raising the exploitation value of your property. Okay, if you have a chalet and it's not renting out, it's going to be exchanged at the market, but when you're renting out the chalet, it's worth another value, and this is what we're going to determine in this video. So instant equity, buying undervalued. This one is plain and simple. You're buying something that's worth $500,000 and you're paying $450,000. You have an instant equity of $50,000. Traps in instant equity. The thing that I see the most happening in instant equity is that people buy in a bad location. Like, you can have a good deal, you can have $50,000 of equity up front, but if the market is going down in that location, you're not really having a deal. It looks like a deal on paper. So remember, it's better to buy something at the right price than buying at a lower price in a section that is going lower. Okay, I'm gonna show why I think this is to be true. So raising the exploitation value. Exploitation essentially means that it's like a business. You have a real estate property. If it's not renting out, it's going to be worth the value of the property at the market that people are willing to pay, because it's going to be perceived at higher risk. When there's no money coming in, people are going to be willing to pay a lot less for that property. So buying the property at the value of the market, okay, I usually do this. I usually buy something that's close to the market, but I see that the rents are way too low. Like, sometimes I'll be buying in a 6-unit property, and that you realize that the rents are $200 too low on each unit. Well, let's say in your area, the cap rate is around 5%. Okay, cap rate is if you were to pay cash for a property, say $500,000, and it's a 5%, that's $25,000 of profit per year. Okay, it's also your PE ratio. It's your price to earning ratio. When you take 1 divided by 0.05, it gives you 20. It's also the value that's being created for every dollar of profits that is being created inside the business. Okay, so sometimes I look at this and I see $200 times 6 units times 12 times 20. 20 is your PE ratio, 12 is the number of months, 6 is the number of units, and $200 was the amount that you perceived that was lower compared to other rents in your area. Because you need to know, like, if you're renting out real estate, you already know how much rents are going out for. So you're essentially an expert of how much you should be paying for rent, and you know, if you're buying that real estate property, how much you could be renting for the same or compared unit. So in this example, you pay price. Like the other example, you were making $50K of instant equity. In this scenario, you're making $288,000 because you were able to see that the units were renting for less than they were supposed to be renting for. And a lot of people are not going to buy this, because what they're looking at is that I'm not making instant equity, so I'm not going to buy it. But they don't see the potential to increase the property's value, because if you increase $200, sometimes it can take 2 years, 3 years to increase the value of the property by $300,000. Well, if you refinance that property, you can get another deal like this, and it makes it easier for the long term. So building equity in the short run, okay? I'd rather be buying at the market something that can increase drastically This is one part of why location is so important, because if you're buying in a location where people want to live in, this is going to increase your probability of making money in the long run. It's better to be buying something at market than to be buying something under market in a bad location. Primarily focus on getting something under value is less important for me than to get real estate that can increase in value. Remember, wealth is in the long term, okay? It needs to be sustainable. It needs to be consistent. Buying something undervalued does not mean you're gonna get a deal somewhere else. And if the locations are going lower, your returns are going lower. That's not something that's sustainable. That's not something you can refinance. So getting a deal is not essentially as important as something that can increase in value, because that's sustainable. You can refinance, you can buy more real estate, you can grow your business. Once you increase the value, is what I just said a while ago, you can refinance, get that money, and repeat the process. And why I'm so strong about refinancing is because real estate offers low interest rates. When you're almost at the same rate as inflation, for me, that's like having a printing press. Like, a lot of people blame the government or whatever, the Fed, for having a printing press and they can print money as much as they want. Well, having real estate is pretty much the same thing. Okay, during the process, always make sure that the property cash flow. When you're buying something, make sure it cash flows. You don't want to be buying something that you can't afford if one unit is not rented out. That's gonna lead to massive distress in your portfolio. You respect your debt structure. Like, your capital structure is very important, because if you don't respect your capital structure, the problem with that is that you are going to over leverage, going 10 times your equity. That can be leading you to massive destruction in your portfolio, because it can be not sustainable in the long run. So remember to respect. Like, for me, I always have 50% equity, 50% debt, and sometimes I'll go to 60% or 70, but the next step that I'll do is I'll pay that debt off really quickly. Assets create returns. Okay, remember that. It's the asset that gives return. It's not the money, it's not the debt, it's the assets. So by focusing on saying that cash is king, cash is not king, assets are king. Focus on acquiring assets. When you focus, it will give you an abundance mentality. Focusing too much on debt will inhibit you. It will create not an abundance mentality. It's gonna give you a scared mentality. I hear people talking about big businesses and saying, I'm happy that I don't have to pay their interest. Okay, and they're forgetting about all the profits. That makes no sense. Like, why would that person be focusing on the interest when they're forgetting about all the profits that the business is making? That's why they're growing. So remember, don't focus so much on interest. Focus on profits. Focus on what's left after the deal. Think about it as you're giving money to everybody and you're putting yourself in the middle to make a percentage on that money. So, conclusion to my video. In some cases, it's better to buy at market with the potential for growth and exploitation value. Wealth is in the long-term mentality. Like, always remember, you need to think long-term, okay? Everything you do in life will have a drastic effect in the long term. Like, buying something right now, getting into debt right now, or just essentially getting the value right now and it's giving you a high is not really a long-term mentality or a wealth mentality. And the goal of this channel is to give you a wealth mentality. So don't forget to like, don't forget to subscribe, and hit that notification bell. I'll be posting pretty much every week, trying to give you the maximum value for your time spent.